Welcome back, everybody, to the complete beginners course for ICT students. This video is going to cover the topic of liquidity rates. Introduction to liquidity rates. What is a liquidity rate? Liquidity rate refers to when price targets to take out specific buy-side/sell side liquidity. What is the purpose for liquidity rates? Liquidity rates occur so the opposing team is no longer able to participate in the market. This will free up the market to move in the opposite direction. How do I utilize raids? Liquidity raids give you insight to when the market will start reversing from a certain price point. Example, if I'm looking to sell the market, it is best to see buy-side liquidity ran first before shorting the market, vice versa for buying the market. So how we discussed in the previous video, using liquidity to target it. If we're going to be buying, we want to be targeting buy-side liquidity. If we're selling, we want to be targeting sell-side liquidity. Now, there's various ways to use liquidity, and in this video, we're covering liquidity raids. And how we're going to be using it is if I am overall bullish, I'm looking for price to go up. I would be looking for price to be taking out sell-side liquidity before going up, right? Because we want to see those sellers taken out of the market before price moves higher. And vice versa, if I'm looking to short the market, sell it, I would want to see buy-side liquidity taken before price moves lower. So there's various ways to be utilizing liquidity, and it's the foundation of ICT's concepts. So how would I enter with liquidity rates? Entering upon liquidity rates are more experienced entry pattern, and I'll get into that. ICT refers to these as a turtle soup entry pattern. The best way to utilize liquidity rates is waiting for a confirmation of a shift lower/higher away from the opposing liquidity after the raid to confirm your long or short. So on this example, what I'm explaining here is if buy-side liquidity has been taken, I'm overall looking for lower prices, and I see buy-side liquidity taken, the best thing to do is to wait for the market to drop lower rather than just entering on that raid, because that's a more experienced entry pattern. It's a little bit more risky because you don't know exactly where that raid is going to stop. We can't always predict that. So waiting for a movement lower, remember from video number 2, a shift in market structure, if we can see that happen after buy-side liquidity has been taken, that's a really good confirmation that price is shifting after taking buy-side liquidity. That's shifting from a uptrend to a downtrend. What time frame should I use liquidity raids on? These do occur on every single time frame, but the best thing for a beginner trader is to look during that New York session time zone that we talked about, especially the silver bullet, and looking at, let's say, a 5-minute and a 15-minute time frame and seeing liquidity raids happen. It's a good place to start and a good place to journal and take screenshots of this happening. And I'll show you some examples here. So example of a buy side liquidity raid. If you look on the left side here, if price was in an uptrend and you see price take out a high here. So let's say we're in an uptrend, we have a higher high, higher low, then price takes out, remember each high has buy side liquidity resting above it. So if you see price taking out buy side liquidity, which is above this high here, and then you see a rapid displacement lower, and then you see a shift in market structure, what is that telling you? That it's freeing up the market, right? It's taking out all of the buy side liquidity. So anybody that was pushing to continue going long, or they had their stop losses above here, they're now taken out of the market, which frees it up, and price rapidly displaces lower, shifting beneath the previous higher low. That's now confirming to you that is now shifting into a downtrend, and you've taken out buy side. So there's a few ways you can utilize that. As I mentioned, the best way is to wait for a displacement, a movement lower underneath that low here. A more experienced trader could enter upon the raid above the buy side liquidity and looking for price to move lower. But my suggestion is to wait to see if that is really confirmed. On the flip side, this is a sell side liquidity raid. You can see we're in a downtrend. We see a lower low, a lower high. Then price takes out sell side liquidity. Remember, every single low has sell side liquidity resting underneath it. So price takes out sell side liquidity in here. and then you see a rapid displacement higher. So waiting for something like this where it gets above that high to then start anticipating price to move higher. Vice versa here. If it gets underneath the low, then you can start anticipating price to move lower. So hopefully that makes sense in terms of raids. I'm going to show you another example in here. So this is a real chart example with candlesticks. So this is buy side. Remember, every single high has buy side liquidity above it. This is just like the example before. We have a higher high, a higher low, and then price is taking out buy side liquidity above this old high here. So price is taking that out, and then you see what? A rapid displacement lower. And then you can see a shift in market structure here. Remember, every single higher high and higher low, if it shifts in market structure, if it moves beneath the previous higher low, that's telling you what? That price is wanting to move from an uptrend into a downtrend. And you're also confirming that it's taking out buy side liquidity. Vice versa in here, you can see sell side liquidity. We have a lower low, a lower high. What does price do? It takes out sell side liquidity underneath this low here, and then you see a rapid displacement higher, shifting above a old lower high in here. So it's telling you took out sell side liquidity, freeing up the market, and then it's shifting into an uptrend. Just like this, it's going from an uptrend into a downtrend after taking out buy side liquidity. So this is another example of a liquidity raid, and this is what we would call internal liquidity. Price may retrace to raid internal liquidity. So inside of an uptrend, there may be internal sell side liquidity inside of here. So anything inside of that uptrend, when you're going from a higher high to a higher low inside of that range, price may want to take out anybody that was inside of here. So internal sell side liquidity. It may take that out, create a higher low, and then move higher to attack buy side here. So you see how you're taking out sell side, and then you're taking out buy side. So this is an example of more or less a higher time frame picture, because you could have a daily uptrend, and then on a 4-hour, 1-hour time frame, you have internal sell side liquidity resting inside of that uptrend, and it goes to take it out, and then rallies higher to take out the buy side liquidity above the higher high here. Vice versa, you have a downtrend, you have your lower high here, lower low. Buy side liquidity would be inside of that whole downtrend. It's going down. Any of those internal, because it's inside of it, takes it out, and then rallies lower to take out sell side liquidity. So you're taking out buy side and then sell side. So it's freeing up both sides of the market in here. You're taking out both sides of liquidity. This would be a real chart example of that. You can see an uptrend in here. What does price do? It retraces. So the market is breathing out, and then it breathes back in. And on that breathing in, it's taking out sell side liquidity. So you can see an old low. Any low is sell side liquidity. It's taking out internal, because it's inside of this low to that high. It's taking out internal sell side liquidity, and then it's moving higher to take out what? Buy side liquidity. Anytime we're going up and we're looking for longs, we're buying it, we'd be looking for the buy side liquidity to target. But we can see that it's taking out the internal sell side. So it's freeing up all of that liquidity in there. Now this is an example of a downtrend. You have your swing high here to your lower low in there. What does it do? Market breathes out, breathes back in to take out internal buy side liquidity. So it's taking out the internal buy side. And then what do? We target the sell side, which is down here. That's sell side liquidity. So price reaches for the sell side. So you see how it's taking out both sides of liquidity? This is a really good example of, if you're just in an uptrend, you can see how price breathes out. And when you're breathing in, look for that, anything inside of that up move, look for all of this inside liquidity to be taken. And then price will move back to the original higher high above the buy side to print a new higher high, vice versa here. Now this is something maybe a little bit more advanced, but I did want to put this in the video just so you guys are aware of this. If you reach into a more experienced part, you can refer back to this. But this is what ICT calls the seek and destroy profile. So it refers to when the market is actively seeking out both sides of the market. This usually happens when the market is consolidating, and consolidating means when the market is moving sideways. So it's not going up or down, right? It's just stuck in a range. It's just going up, down, up, down, up, down, not making a new high, not making a new low. And usually what will happen is price will go from being in this consolidation and it will take out sell side liquidity. It'll take out the relative equal lows, but then what's left? The buy side, right? Relative equal highs in here because it's been moving sideways. So price will take that out and then move higher to take out the buy side liquidity. So you can utilize these in various ways depending on the style that you do trade. But let's say you were looking to buy this after we took out sell side, because if we take out sell side, then what's left? Buy side liquidity. So if it takes this out, you can enter down here to target the buy side liquidity. And if you just inverse this, then you could be taking out buy side liquidity first and then targeting sell side. So whatever side is not cleared up yet, you could target that. And this is kind of a real chart example. So you can see that price is just bouncing back and forth. It's just stuck in a really tight, small range consolidating. What does price do? It comes down, takes out all of this sell side liquidity in here, and then targets the buy side liquidity. So you could be entering down here after you see that raid, or you can even see a movement away from it, drops down, and then you could be buying to target the buy side liquidity above this high in here. And if you just inverse this, it'd be the same thing, right? You're taking out buy side first and then targeting the sell side liquidity. So this is just a short introduction to liquidity rates. I'll get a little bit more in depth to it in the later portions of the series. So hopefully that was a short, clear example of what liquidity rates are. As time goes on and you do some back testing and you go into the real market, you'll be able to see these characteristics and these phenomena play out a lot. It's more or less a lot of experience and chart time to see this unfold. So until the next video, I'll see you guys there.